Good morning and welcome to the last trading day of 2025. We have made it to the end. It's been a good year for retail investors, individual investors who outperformed institutional investors. And it's been a really good 3 year run. So I look forward to 2026, trying to find stocks that are priced right, set up right, and are going to be success stories for the new year. How you doing this morning, Daryl?
Doing wonderful, Victor. It's good to be here. Hello, everyone.
It is good to be here. It's good to talk about stocks. It's my favorite thing to do aside from family and other hobbies that I have. Um, how are things going with your channel this week, and how are things kind of wrapping up the year? How have things gone for your channel for 2025?
I've had a lot of growth this year. That's really when I got started with this, and collaboration with you has really helped. So I appreciate that. Yesterday, I did put out the stock review for Citi, whether it's a buy, sell, or hold. So I looked at the turnaround plan that they've had in place for the last 5 years. And based on the results of that turnaround plan, that seems to be really successful based on the stock price over the last couple years. And the new CEO that was put in place in 2021. And she's been successful enough where she was elected chairman of the board this year. So I think that turnaround is fully in place, and I give my price targets and do some sensitivity analysis on that. So that's in this video that I released yesterday.
Yeah, I noticed that. And very good stock to pick because it performed really well in 2025. And I think it's going to keep going in 2026.
I do too. I have very high hopes for Citi. I think they have a lot of opportunities this year to take care of.
Yeah. And um, on my channel, I've been releasing some videos publicly and as well as to members. Yesterday, I released a video looking at industrial stocks, the best and worst industrial stocks. And it's interesting once I get into industrial stocks, there wasn't a lot of good opportunities. A lot of them are bid up because they've had a really good 2025 and 2024. So took a tour through industrials, released that video out to members, and then I've been releasing 30 days or more after I released content to members. I release it out publicly, and these are the videos that are out publicly. And I should have a pretty good string of public videos coming out in January, as well as to members. I'm going to put together a video today. I'm going to cover the NeoCloud companies. So those are the companies that are pure play data center companies like the CoreWeaves and Nebius like companies. And I'm going to review those companies. I'm going to review their financials, including balance sheets, because the balance sheets are really important when it comes to those businesses. So that'll be produced for advanced members, and I will deliver that today. I'm also putting a lot of shorts out there, which have been really popular. People really have given positive feedback on the shorts, and thanks if you provided feedback on them. I appreciate that. I'll continue to do so. And of course, we've got the live stream that you are viewing as I speak. So the market is flat. Boy, it's been kind of a fade, so to speak, at the end of the year. Santa Claus rally wasn't much of a rally. It's kind of faded toward the end of the year. What are your thoughts on how we're ending the year?
Yeah, it hasn't quite been as strong as the typical rally. If you measure it from the 15th onward, it's typically over the last, 75 years,
Mm-hmm.
been up about 1.4% on average. This year, if I get to the right chart here, there we go. So on the 15th, well, let's go from the 12th of December. So we closed, let me get my calculator out. We closed at 6827.41, and that was on the 12th. So Santa Claus Rally statistic that I'm looking at starts on the 15th. So we closed at 6896. So 6896.24. That would be only a 1.01%
Okay.
increase since the 15th. So we're falling a bit short of the 1.4 average.
It's still higher, but it's just not like a big number. It's just a
Yeah,
small
it's
number.
definitely better than last year. So if we look at SPY last year, just go to 1 year at a time. We were down 2.4% last year. The year before we were up 4.6. We were down 5.8 in 2022. We were up 4.5 in 2021 and up 3.7 in 2020. So last year we definitely pulled back, and
Yeah.
then 2 years ago we pulled back.
I remember that, and I remember, because we in 2024, we had back-to-back excellent years. I'm like, "Okay, well, I guess the party's over," and then we started 2025, and obviously this year's been good, so it's like, "Alright, guess the party kept going,
Yep.
and stocks will continue to go higher." So this fade, I'm thinking early in 2026, I could see some selling. I could see some shareholders that are sitting on a big gain. They'd like to redeem some of that gain, maybe partially, and they want to manage their taxes. So if you sell early in January, you don't have to pay your taxes for a year. So that's not bad for the cash flow. So maybe we see some selling due to profit taking. Um, that's all I can think of. Other things that are going to help stocks or other factors weighing on stocks will be that people will receive higher income tax refunds. I'm going to call it in the springtime, and they'll have wallets full of money to buy discretionary goods and make themselves or maybe take a trip. So travel should be good. And we've looked at the, or I should say, you and I were talking about unemployment figures. Those are not too bad. The unemployment figure is not a problem yet. And the new report that came out today showed that the um, the number of job losses, initial jobless claims, was lower than expected. So that's all good. What are your expectations of 2026? Just high level.
So you mentioned one tailwind. Another tailwind has to do with the change in depreciation for small and large businesses, where they'll be able to write off 100% of uh, capital investments, where before they had to depreciate it over some years.
Hmm.
So that's going to be a stimulus to the economy, I believe. The one headwind that we'll have is we're into a midterm election year. That can cause a lot of chaos and volatility in the early months of the year. And then typically after the election, you see a rally towards the end of that year. So that's both a headwind that we'll have to watch as we go through the year, and then hopefully we'll get that typical rally that occurs after the decision's been made and people know where we stand, the uncertainty's gone, or at least minimized, then things can pick up from there.
Yeah, yeah, it should be a little noisy, especially in the summertime. A lot of news stories will come out.
Another
Right.
tailwind is just earnings. The earnings are up.
Mhm.
Estimated earnings are up for next year. So I think there's more tailwinds than there are
Mhm.
headwinds, but those headwinds could be pretty major that we'll have to work around.
Yeah, and I've been monitoring like travel and other industries that tell you, is the consumer spending, and travel's doing really well. The airlines are selling out their airplanes. They're ordering more airplanes because they need more capacity. So that's all, and to me, that's pure discretionary spend when you see um, the traveler um, booking trips. That's to me that's a good indicator that yeah, the the consumer is willing to spend. The consumer's all right. And some of these reports that I get, they kind of are sometimes economic reports are a little too um, generalized or general or high level, and they don't give you specifics that you can kind of understand. But what I could understand is, hey, travel is booming. Okay, well that means that the consumer spending money. That's discretionary spend, 100%.
Yep.
All right. So before I forget, I wanted to thank our newest member, um, Cody Redinger. He joined during my stream yesterday. So thanks so much, Cody. And as part of any level of membership, you could ask for stocks to be reviewed on the live stream. So if you have a stock, you could pop it in the chat. We'll take a look at it. And we're going to look at GMAB. It looks like Shadow Guy's got that stock in mind. And Daryl was actually did some prep on GMAB. So we're going to take a look at that one. And if you're not a member already, take a look at the options you have. You could visit the options on my homepage of my YouTube channel and take a look at the different options and see if one's a good one for you. So, looking at the first stock we're going to look at is GenMab. And this stock here, we've looked at it a few times on live streams, and it's doing really well over the 1 year. Over the 5 year, it's seen some pressure, but the business itself is doing well. It's growing really well. The forward PE looks okay because I know it's growing, 21.7. The analysts believe that it's discounted. Over the last month, it's seen some pressure. And I know that yesterday's sell off in biotech, it seemed like all biotechs were selling off. So it wasn't just GenMab. Historically, stock's been or the company's been growing revenues really well. Trailing 12 months growing at 29.5, which is very good growth. And this is a very profitable entity. We look at some companies, and like I was mentioning that I was looking at industrial stocks yesterday. I created a video, produced it for members of the channel. Um, and their gross margins are like 20 to 30%. Well, look at this gross margin, 94%. Wow, that's a very high ceiling. And they get to keep 41% of their revenue as profit. It's very attractive. That's a very, very attractive business when you get to keep that portion of your revenue in the form of profit and in the form of free cash flow, 34.5. So these numbers are excellent. This is a desirable business. It's got revenue growth and very profitable type of business. The balance sheet's in good shape. They have 3.4 billion of cash, only 142 million of debt, so they can write a check and pay off that debt immediately. No problem there. So we have 5 analysts that are doing price targets. That's where that discount came from. Now, this is the forecast. This is looking through the windshield. What's the business going to do? And this growth looks good. It looks good that they're going to grow in 2026 by 16.5 and just keep growing. Now, they are going to hit a wall of growth 3 years from now. Their earnings per share is going to expand, and the P ratio has really dropped. I don't think that's correct. I think because this is a foreign stock, it didn't calculate the P ratio correctly. But the overall profitability looks good, and the growth on that top line that we expect over the next 3 years looks good. Overall, I have this stock discounted. It's and I think you can find a lot of stocks in biotech that are discounted, but I think it's 38% discounted. I'm using a high discount rate. But that's part of the process. Next is it a good time to buy it? Right. So I'd like to give the screen over to Daryl to look at the charts and see what he is seeing in the charts.
Yeah, I was just adding the news here from, let's see, 2 days ago. So we've been looking at this chart, and I mentioned in my weekly review, it would have been awesome to have known about this when they broke out above this price or basically sideways consolidation, because they had a really nice run up to a peak of about 33.63. I drew a line across there. We came up and tested it almost to the penny, and it was rejected off of that resistance line. I have a downtrend that's connected here and here. It broke above that and is currently trading and has been trading, but I'm going to suspect after I show you a couple of additional charts that this support line is going to come into play, and I'll tell you how I get there in just a moment. I had actually on the 19th of December had a price target on this one of 36.64, and that was based on this cup with handle pattern. And it is breaking down and failing. It made it up to 33 and is starting to fail. So my immediate reaction, based on all the cup and handle patterns that I've seen, and I've only been doing this for a few years, so I haven't seen as many as a lot of other people. But my experience with these is they will hit their target or get close to their target about 60% of the time on these cup with handle patterns. So based on my little bit of experience, I went to Gemini and I said, what is the probability rate or statistical rate on a cup with handle pattern? Guess what they said? 61 to 68% on reaching its full measured move. Getting at least 5% higher, it'll do that at least 95% of the time in a bull market. So what Gemini is telling me aligns very closely with my own personal experience, and that's why I talk about these cup with handle patterns, because about 60% of the time they work. This one doesn't look like it's going to. So I want to look at their seasonality. So over January and February, over the last 5 years, not including this year, they underperform in January or February. Only 20% of the time is the price higher at the end of January and higher at the end of February. And the average move down is 6.6% in January 4.4% in February. So you're looking at 11%. And they only exceed the price at the end of January 1 out of the last 5 years. That's pretty strong statistic, in my opinion. So I saw a discussion in the Discord yesterday, and that made me go and look at the seasonality and make a decision on the shares that I hold. And I'm going to go ahead and close them out and revisit this back in March. So I have one more chart, and this actually puts seasonality right in the chart along with the price. So we can see that from a seasonality perspective that July and through into September is the high points of their price action. They seem to have done very well through October. Then they had a sell off. They're back there again now. But when I look out what it looks like over the next basically 3 months is the seasonality is going to drive the price down. So this particular indicator that I'm using, the Williams True Seasonal indicator, aligns with the seasonality chart that I see on stock charts. So based on that, I'm going to go ahead and close out my shares because I think it's really going to hit this anywhere from $29.75 down to about $28.76. So once it does that, then I'll revisit this one. So that's my thoughts on GenMat. I really like this stock, but I think over the next 3 months that it's going to feel a bit of pain just based on seasonality trends. And they did announce this news on the 29th where they're discontinuing a drug for small cell lung cancer. And they said there was no impact to 25 guidance. Well, that's only 1 day or 2 days. I want to know about 26 guidance, and they didn't mention that, I don't guess.
Mm-hmm.
So I'm going to close this one out today. It looks like in the pre-market that they are, they're
A little bit higher.
Yeah, just a little bit. So I'm going to close it out this morning and take a look at this one again towards the end of February, beginning of March.
Yeah, good stuff. Great stuff. So it looks like Shadow Guy, he's suggesting if anybody's interested in additional chart information, Thomas Bulkowski, and take a look at that person online. And appreciate the comment, Shadow Guy. All right, so Mike. All right, so Mike's winner chicken dinner. Good to weigh in, or good to see you weigh in, Mike. Good morning. All right, perfect. So let me kick it over to my side here. We had a request from Ricardo. Take a look at Camco, and also another miner. These guys are actually, they may not be miners. Camco provides uranium for the generation of electricity. It operates through 3 segments: uranium, fuel services, and Westinghouse. The uranium segment engages in the exploration for mining, milling, and purchase and sale of uranium concentrate. The fuel services segment is involved in the refining, conversion, fabrication of uranium concentrate, as well as purchase and sale of conversion services. The Westinghouse segment operates as nuclear reactor technology. Interesting. I saw the 3 Mile Island documentary. It's on Netflix. And 3 Mile Island was closed. It was being operated by Constellation. And it was closed because it wasn't making money. That's simply the reason. It's like just doesn't make money. And I remember the one closest to me, it was also closed because it was an expensive way of generating power. I remember the per kilowatt cost of the reactor near us, it was like 5 times more expensive than the other methods of creating power, and electricity bills actually went down when they closed it. So, I'm curious to see, well, what's gonna change? Like, has it become more affordable? I don't have the knowledge to be able to answer that question. I don't know if you know anything about that, Daryl. Is like, uh, nuclear power becoming more efficient?
I don't know. I haven't really researched that, so I really don't know, to be truthful.
Because, I mean, the big positive of nuclear is you don't create like, if you burn coal, it creates a lot of pollution, and that's an undesirable for sure. Nobody wants polluted air that you have to breathe, and nuclear doesn't create that type of pollution. It creates, some waste that we have to be real careful with because it could really hurt people, and that waste is hard to manage once it has to be managed. But it does provide clean power. You don't pollute the air. I don't think you pollute the water. Um, but it's just I don't have any expertise, but it's been expensive in some examples that I've seen. Now this company is doing fantastic. It's up 74% in the 1 year. Look at the 5 year, 576. So this has been a fantastic stock. It has become a $39.8 billion market cap company. And what I'll do on this one is I'm curious to look at their actual income statement off their website and see how profitable they are, just to kind of look at real numbers and see, oh, what's their gross margin? What's their net profit? What has it been over time? And their forward P is really high at 72.6, and analysts think it's discounted. When we look at their growth, the growth has been really good for 3 plus years. They've been growing 26, 38, 21, 23, and that looks really good. And when we look at their ability to be profitable, their gross margins have been growing. They kind of hit a low point in 2021. Now they're up to 36.3, and their profit margins at 15.18. So they're really hitting stride. Now it does have kind of a low ceiling, right? We're dealing with a company that has gross margins in the 30% range. Free cash flow looks good at 28. That's good looking free cash flow number or percentage. Overall free cash flow, 972 million. Now these guys are in a very hot space, which is nuclear power. It's receiving a lot of attention. A lot of investors are betting that, hey, nuclear is the future, and these are probably going to be good long-term plays. It fits into the whole story, the story that AI is driving the growth in data centers. Data centers need power, and the power has to come from somewhere, and that somewhere could be nuclear. So these guys are in an industry that is receiving a lot of positive attention. Okay, so they are growing well. Let me take a look at their balance sheet just to make sure they don't have a ton of debt, and they don't. They have net 164 million, and therefore their balance sheet's in really good shape. When we look at 6 analysts are covering the stock, they're pretty positive on this company, saying that on average it's discounted by 25%. Let's take a look at their forecast. So their forecast is saying that this year they're going to grow about 10.4%. Their profits are really expanding. and their forward P is really high. Next year, they're going to grow by 8.6%, and then 9.5%, and then almost 5% in 2028. So it just, single digit, steady growth, profits are expanding. That PE is going to stay high. It's the stock price has really gone up. So yeah, the PE ratio is elevated. It certainly is. So I'm not fully convinced. You got about $1 billion of free cash flow. I have to multiply that free cash flow by 40 to get to their market cap. That's an expensive stock. It's not a place where I put a lot of my capital. In fact, I don't own any companies like this. And part of it is I just don't understand how they're going to make a lot of money over time. We've had nuclear for a long time, right? We've had nuclear generating power, I'm going to say since the 60s. And I don't think it's become all that popular in the US and all that profitable in the US. So I'm gonna kind of stay out of an investment like this and just let others that maybe know this space better than I do invest in it. Their operating cash flow is improving. This looks really good. For them to grow operating cash flow, it's a very good sign. And they put money back into their business. Now they're not running nuclear reactors. They're providing, the fuel and that's that part of the whole process. So they're probably going to be okay. So that's kind of like my initial thoughts on it. It'd probably be a pass for me because it's just not driving enough cash flow. You're paying a really high PE for the company. It's really set for real, in this price. I'm thinking to myself, investors are like, oh, this thing's going to be great for the next 10 years. And they're pricing in the growth for the next 10 years. All right, well, there's not a lot of meat left on the bone for me. I'm buying in, and it's already priced that it's going to do great for the next 5 years. What's left for me as an investor? Is there going to be an upside story? There's probably not many left. Everybody's already betting that, hey, nuclear is going to be awesome. And if you have like a pullback in the AI story, like let's say we get into 2026 and you have some stories around, well, hey, we saw Meta pull back on their CapEx into the data center. Now, Microsoft, let's say Microsoft, just kind of making up a story, Microsoft's pulling back in a big way. Maybe another company is pulling back. And it creates this narrative that, hey, the data center is not going to grow as fast as we first thought. That's going to put pressure on companies like this one, where it's like, all right, the power necessity, although we're going to need more power, it's just not going to be an overnight thing. So maybe this stock sells off in 2026. So that's what I'm seeing. Let me kick it over to you. Maybe you can share the charts and then we'll move on to the next one.
Yeah, so on this one, we'll just look at this 4-year chart because they have been trading within a trend channel. They're at the top of that channel right now. So to me, it's high risk at the moment. They did have one breakout to 109 or so above the channel. But right now they're trading at the high end of it. So to me, it's a high risk at these prices.
Mm-hmm. Yeah, and if we look at the 30-day on it, it's still going up over the 30-day. It's really seen just a lot of interest from investors who piled into this one. All right, great. All right, so can we move on to the next one?
You bet.
All right. So the next one is, I think, related. Albemarle Corporation, or Albemarle. And these guys provide energy storage solutions worldwide. It operates through 3 segments: energy storage, specialties, and CatGen. The energy storage segment offers lithium compounds, including lithium carbonate, lithium hydroxide, and lithium chloride for the use in lithium batteries used in consumer electronics and electric vehicles, power grids, solar panels, high performance greases, specialty glass used in consumer appliances and electronics. All right. So these guys are in a different part of the whole energy complex. It looks like the stock has sold off over the 5-year, but it's really picking up steam, looking real good. And $16.7 billion market cap with revenues of 4.95 billion. They don't have a forward PE. Take a look and see what we're seeing from gross margins perspective and so forth. And these guys, how long have they been around? So these guys are in the material space. They've been around for a while. IPO date 1994. So 31 years. So they've been around a while. It's not a new company. All right, looking at the financials. Okay, so the 2024 year was not a good one. Looks like they grew quite fast. Maybe they acquired a business. And then they had a contraction year in 2024. And the trailing 12 months, they've been contracting by 24%. Let me look at the quarterly. Yeah, it's red across the screen now. They are beginning to stabilize. I think Ricardo asked about this. And do you know of a story around this company, Albemarle? And is there like a positive story out there? Like, hey, they're going to go to market with a new product, or what's causing the big run up? So
I've heard of this one, but I haven't really, looked at them in any detail, so I don't know any details about this one.
mhm. Well, the stock's working this year. So they're doing free cash flow now. That is a change. Well, they had free cash flow a couple of years ago. So that's good. They have some free cash flow, but that contracting top line is got me a little worried. If your revenues are coming down, what's going on? Are fewer customers buying your products and materials? Is there less demand for your materials? The commodity price going down? I mean, all those things are impacting the company, but something's creating uh, or encouraging investors to buy into the stock, and that's why the stock's up about 70%. All right, so we have free cash flow is positive. Now, the gross margins, man, they're kind of all over the place. We've been in the 30s, 40, 12, 1, and then 12. And this is probably the commodity price collapsed, and they were sitting with, it cost us just about as much to pull the materials, sell the materials, as the revenue coming in. Now it's getting better, but it's not good. 12% gross margins is terrible. That's not good. And it's hard to make money. It's hard to make a profit when your gross margins are that low. See, we saw GenMab, it was at 94, and they ended up with 41% profit. That was attractive. These guys, boy, you got to operate really, really well just to turn a profit. It's very easy to go into the negative when you have gross margins like that. And they do have a little bit of free cash flow, but not much. So this one here has really been bid up, and I can't figure it out. So I'm going to ask Gemini. That's been my go-to now. Gemini has been delivering some good information, so we're going to ask Gemini next. But let me take a look at the forecast real quick. So this is why the stock may be working. Is this forecast looks good? Looks good. It's supposed to grow in 2026 and really begin to grow in 27, 28, and We're going to skip 2029. We're going to take the year off and then go over to 2030. Profit is going to expand in 27, bringing down the PE ratio. So maybe they have a source of the materials that they sell, and it's going to go online in a couple of years. It's almost like a biotech company that has a drug that is going to be going to commercial phase of that drug in a couple of years. So that does look interesting. I think that's what's driving investor interest in this company is they want to buy early because they believe like this stock's going to flourish. And a lot of material stocks have been doing well, by the way. I've looked at material stocks. There's a lot of winners in materials. So this one here added to the list of winners for 2025. It's looking good. So why don't I kick it over to you? And while you do that, I'm going to ask Gemini to give me some information on what's been driving the stock price going higher for this company.
So they had been in a downtrend since the end of 2022. I drew this downtrend line. You can see that we connected it here. It was tested here, nearly tested here, broke above it back in July of this year, and then broke out above it once more, came down and tested it, and hasn't looked back from there. So had we looked at this stock in September, if it had kept above this line for a week or two, would have been a great entry point on this one. And because it had broken out of a long, 2-year downtrend. So now we'll just go to 1 year and look and see what we see. They're trading down today, so a little bit of decline. Keep in mind that the volume is incredibly low over the last 2 weeks. The last time we had any volume to speak of was on the 19th, which was a Friday. The following Monday, there was trading volume about up to the 50-day moving average. But since that time, because of the holidays, the volume has been very light. They are testing the 60 line on the RSI. They broke down below that for a day on December the 4th. I like when these are moving to higher prices that we see the same level of momentum. So the momentum on November the 19th was about the same as we had on the 26th. Even though the price is higher, the relative strength stayed the same. When I become cautious is when I see higher prices and the RSI failing to reach the same level of momentum. So this one looks good there. They crossed above the 60 line on the 10th of November. They've come down and tested it a couple times. So my initial thought is, can it hold this 60? That's something I would be watching for. The 21-day is moving higher. Looks like the rate of change on that is slowing down a bit. 50-day is moving higher and the 200-day is moving higher. They're sitting about 70% above that 200-day. That makes me a bit cautious. The money flow is negative at the moment, and the accumulation is really kind of at the lows that we've seen for the year. Despite these rising prices, the money flow for the last, looks like it's been negative the majority of the year. There have been bursts where the money flow went positive. So I don't know. I'm kind of getting some mixed signals on this one at the moment, but boy, you can't deny what it's done since this breakout above that downtrend line.
Yeah, I mean, if you look at the longer term forecast, it looks pretty promising. So I'd have to say, that's where the enthusiasm is for the stock. And it looks pretty darn good if you look at the longer term forecast. It looks like Ricardo's got a comment here. Let's see here. So the rise has been mainly because of the lithium market is increasing. Yeah. So that matches what Gemini. So I asked why it's gone up, and it's saying ALB went up significantly in the latter part of 2025, primarily due to the improving lithium market with rising prices, strong demand for energy storage solutions. I agree. Yeah, it's all good. So it's if you play in these markets, like if you invest in materials, just be aware you got to track the commodity price. I would have to think that this particular market is going to stay strong for a while because it's not like we're using less power. We're using more power. They've got data centers coming online. We're selling a bunch of EVs. I bought an EV in 2025, and I could tell you it had an impact on my on my home's energy consumption. I put solar panels on our roof like 3 years ago. Well, and they did ask me back then, "Hey, are you going to get an EV?" I'm like, well, "I'm not planning on it." Well, now I have an EV, and I could see the impact on my energy consumption. It's like, whoa, hey, those EVs really consume power. So the demand for lithium, I think, is going to stay pretty strong for a while. So I can understand that long-term forecast is positive for the stock. So I think Ricardo, you like looking at energy stocks, and um, this is a pretty good market for you to have expertise in because we're just going to deal with more demand for energy. So it's a pretty good place to get good knowledge. And the last comments on this stock is that the 5 year shows that, hey, this stock had been trading above $300 per share. So this thing can continue to go higher, especially if the story, kind of holds strong on data center growth and so forth. These guys are probably going to do well. I've seen some of the commercial solar installations. These things are huge. And what they do is they store the power on batteries. Well, if you have a data center and you store, during the daytime, sun shines, boom, you got solar producing power, and then at night you run on batteries. So that totally makes sense. There's going to be a higher demand for these batteries. So, and EVs too. EV sales are doing really well. I'm seeing EVs everywhere. I'm in Southern California, and we are car crazy in California. I don't know if you guys knew that, but California, everybody has a car. It's not like New York where subway's really practical. Um, California, the mass transit's not that convenient. It's getting better, but it's nowhere near what the Northeast has with regards to mass transit. So everybody has a car, and we have so many EVs. It's pretty crazy. So thanks for asking about that. Two good, interesting stocks. All right. So looking at the stock market, we've got the sell off continues. We are going to limp into 2026. It's still a really good year. It's just the last 5 days have been a little crummy. We're down a bit. This is what makes me think we may see a sell off in early January. Investors aren't in a mood to buy. Maybe they're going to be in a mood to sell next week and take some of those profits and then pay their taxes a year later. But we'll see. That's what my spidey sensors are telling me. I don't necessarily, invest all the time using my spidey senses because I'd probably lose a lot of money. So, but the year to date, we're still in the green, 17%. That's a good number. What's the average? What's the average return on the S&P? So the average return for the S&P is, since inception, 10.5. Last 50 years, 11.96. Last 10 years, 14.66. So we're above all those averages at 17. And do you understand what they're saying here, or what's stated here? Inflation adjusted return. Are you decrementing the amount of inflation that was in that period of time? Is that what they're
Yeah,
doing?
that would be my guess. So that's the difference between nominal and real.
Okay.
Yep.
All right. So
Let me show you a chart on that real quick. So I draw these long-term trend channels. This is on the S&P 500. Then I have these delta bars that's basically measuring the rate of change on this line. And this is over 3 years because it's a little hard to draw just 1 year. So you always have to divide this by 3. But I come up to about 12 on average since 2009. We've had about 12.4% on average. And then over here between 80s and early 2000s, we had 44.7, and divide that by 3. That was about a 14.9 percent compounded rate of change. And then we have this big red bar in here. This is one we don't want to get stuck in, but this can happen on occasion. So basically from the end of 2000 until the end of 2010, we went nowhere, basically. So whenever anybody quotes those kind of numbers, it's kind of interesting to go back and look at specific time frames and how that can be impacted. This is called the lost decade, and called that for a very good reason, because we basically went nowhere.
yep. And in a way, like and what time period is that?
That's from the crash, the internet bubble,
Yeah.
all the way until the end of the GFC.
Yeah. Yep. I remember those times. And back then, bonds were actually, they were very investable. You
Yep.
still have bonds competing with stocks for overall performance. That's the last time. After the 90s, bonds were never close to stocks. It was stocks grew wealth. And the other interesting thing is, during that period was a good time to buy real estate, because I think it was 92, 93, 94, you had contracting prices in California. So I'm going to speak about California because that's what I know. And it was a good time to buy. And then you saw an increase. It got, out of hand. And then in 2008, 2009, 2010, we had a crash in the housing market. Great time to buy. Crashes mean great opportunity. It doesn't mean everybody goes crazy and worries about it. It means investors should do their homework and make a lot of money over time. That's what it means to me. And so it's interesting to see that. So I don't know that we're heading toward that unless we have a big AI bubble pop. I don't think that's going to happen. I think the companies spending on AI, their stocks would suffer, but they could kind of afford to have this kind of research and development. Meta's got plenty of money. The only one that's kind of doesn't have a lot of money is OpenAI because they're new. They're a young company. All right. So good stuff. We've got a couple more stocks requested by Magical Self. He's looking at AKAM and then EQIX. So we'll take a look at those. Let me take a peek at the comments here just to make sure I'm keeping up with things. And then what do I think about JD? JD has been lagging this year. I think JD is interesting, but I prefer Alibaba. JD, yeah. So see, JD is lagging, and part of their problem is I believe their margins are not great. They're kind of a supply chain company, and it kind of makes a lot of sense within China because you have so much manufacturing, so much production. The stock's not working. I'm not investing in JD. I'm big in Alibaba. Glad I'm big in Alibaba. And I'm big in Futu. And I'm buying an ETF for China stocks. But I am buying into that ETF, by the way. I'm actively buying more shares. I think China's economy it's firing on all 8 cylinders. And I think it's going to keep firing on all those 8 cylinders. Domestically, they can't grow their economy, but their exports are just incredible. Mike. So SPHY. So we'll take a look at it, Mike. That one is third on the list. Thanks for bringing up materials in the energy complex. Really good, interesting thread. But it goes to show that, there's markets that are really catching this rally. And the lesson there is, try to get to a material sector early and then participate in the rise. Also be aware, material sectors tend to be cyclical. They go up for a while and then they go down. So Ricardo wants to talk a little Microsoft. I think Microsoft's a good idea for 2026. I don't think it's going to break the record on performance, but I think it's a good idea for a lower risk stock. So let's go over that. It's number 4 on the list. Okay, so we're going to go over AKAM. Akamai Technologies engages in the provision of security delivery and cloud computing solutions in the U.S. and internationally. The company offers security solutions that include web application programming interfaces, protection solutions, which protect web API, mobile app traffic from attacks, bot and abuse portfolio, which provides solutions to help customers protect against threats. Okay. So these guys have been around for a while, but they haven't, my observations, they haven't kind of been one of the top, cyber stocks. I know of them because they've been around for so long. So let's take a look at their growth and everything else. So for the year to date, it's been under some pressure. For the 5-year, it hasn't been going anywhere. Maybe that's why I haven't heard that they're near the front of the pack. You have companies like CrowdStrike and others. 12.6 billion is their market cap, revenue of 4.13 billion. Forward P is 12, which is a very value stock like PE ratio, and analysts think there's a discount. These guys are growing single digit. And in this space here, for what they do, they should be growing faster because other businesses are growing much faster than this. So to me, you want to look at a stock and compare it to its peers in that particular industry and try to interpret, are these guys keeping up with its competitors or are they falling behind? If they're growing just a tiny bit, it makes me conclude they're falling behind because CrowdStrike's growing by like 30%. And I could give you a list of 6 cyber companies that are growing 20%, 15%, 30%. And what that shows is customers are opting for CrowdStrike or Fortinet, Palo Alto, um, Zscaler. They're opting for those technologies instead of Akamai. And if that's the case, Akamai's becoming less relevant, less important, and someday will kind of be forgotten. And companies will not buy their product all that often. They're positive numbers, but they're just compared to their industry, they're not good numbers. Looking at their gross margins, 59%. That's okay. Profitability is there. So this is like a value stock, but it might be a value trap. Again, comparing it to its peer group, and I could do that. We're going to compare this one to its peer group because I think it'll be interesting to kind of line it up against 6, 7, 8 cybersecurity companies. So we have 14 analysts covering it. It's expected they're going to keep growing. Top line revenue, single digit. The single digit is getting a little better. That's good. And profits are expanding, bringing down their PE ratio to a really low number. CrowdStrike's PE is really high. We're going to look at it in a few minutes, but yeah, this will be interesting to pop it in there and compare it to its competitors. And I'll jump into that in a few minutes. So we looked at the forecast. Forecast looks good. I'm willing to bet their balance sheet's going to be fine because these guys make money. They haven't been putting a lot of money into their R&D. So total debt, 5.2 billion. Net debt, 3.4 billion. Debt to EBITDA, 3.36. So they have more debt than I expected. They do have, they're on the just slightly beyond the line of acceptable debt to EBITDA. So that's interesting that they have that much debt. Why do you have that much debt? You're kind of a slow growing business. That's a surprise. So that's another decrement to their overall value. I decrement it because I think it's the right way to treat debt. It's a negative. Decrement it from its overall value. And I'll show that to you in a few minutes. So let me kick it over to you. And while you look at the charts, I am going to put Akamai in a model right next to its competitors, and we'll see how it stands up.
Okay, so we'll look back 15 years. I want to try to find where it finds a quiescent state on its pricing. And this line right here, right around 75, it seemed to have faced resistance there in 2015, 2018. They broke above in 2019, traded above it for 4 years, but finally came down and touched it once more. Rose again and have been trading pretty much right at that value for the last few months. So let's step in now and just look at 1.5 years, maybe a little bit more. So I drew this longer term downtrend. And I want you to see where I attached those lines. It's basically at the high we saw In 2024, they came down, and we're attaching it here.
Uh-huh.
They did break above that, which is a good sign, and they've been able to maintain that level for a bit. So let's go into just 1 year now. And I see a resistance line around 103. That's their peak in February. Then I see another gap at this gap down. See another resistance line at this gap down. That's pretty much where they're trading. Look how they've been toggling right around that area since they gapped down at that point. So that's a pretty strong resistance in my mind. This line here now would really become support. So, they really need to break above this resistance line, which they just haven't been able to do for the last 2 months. So looks to me like they could travel sideways for a while until they can significantly break out above that resistance line. The 21-day is increasing, but they're coming down to test that today, and it looks like it's beginning to roll over a bit. 50 line is still increasing. The 200-day is flattening out. We did have a golden cross on this one where the 50-day crosses above the 200. Once again, the volume has been pretty light. They still have pretty good RSI at the moment, 53, so it is in bullish territory. The PPO had a bearish crossover in bullish territory right here that it hasn't been able to overcome yet. And the accumulation is once again at a 52-week low. And when we talk about performance against their industry group, they have underperformed their industry group by 15.36% this year, while that industry group is only underperforming the SPY by 7%. So they're underperforming the S&P 500. They're underperforming the technology sector, and they are really struggling at this resistance line.
Very good. Give me a second here.
Well, while you're doing that, I'm going to look back here. They seem to have had a change of character. So in 2022, they had a big sell-off, but no surprise, nearly everyone did.
Mm-hmm.
They had a nice rise in 2023, but what's going on now? We've had 20% years for the last 2 years. So something right around here has really impacted this particular company.
And I did the numbers, and I was kind of surprised by what I ended up calculating. So let's go over there. All right, let's hit the numbers, and we're going to come back to what Gemini is saying about this company. So Akamai discounted by 28%. And I'm using a higher discount rate versus like a CrowdStrike because of their balance sheet. Look at the balance sheet here. These guys have lots of cash, almost no debt. These guys have debt. Okay. And it's like, why do you have debt? Everybody else in your space doesn't have debt. So I'm increasing the discount rate. Higher risk, higher reward. When I do that, I still get a discount, even though I'm growing their free cash flows by very small amounts, but the stock's just so discount or sold off. The earnings per share giving them a PE ratio of 18. They deserve an 18. It's profitable business. They have margins of 60%. They're growing single digits. The single digits are going to be high single digits in a couple years. So overall, this surprised me, 28% discount. And cybersecurity has been kind of a space where I think some of these businesses are too expensive. Let me give you a tour. So 28%. CrowdStrike, I think, is priced way too high. They are not growing their free cash flows all that well. So their stock's just a, favorite to many investors. And they are growing well. But their PE ratio is really high and it's priced really high. I made some good money on Zscaler. It was really sold off for a long time. I recovered really nicely. I bought it when it was sold off. I made good money on Zscaler, sold it. It's priced 7% too high now, in my opinion. Rapid7, small company, discounted. Fortinet, discounted by 38%. This is the horse that I'm riding right now in cyber, as well as Okta. Started buying into Okta. Okta's really nicely discounted. Okta's growing 15% top line revenue. It's like, man, what does a company have to do to get some attention? So these guys are growing well, 15%, growing better than Akamai, better discount. And then Rubrik is only producing cash flow at this point. No free cash earnings per share. But look at this puppy. This is why I'm buying Okta. And their earnings were really good. So I started buying into Okta. That's one of my new moves. And so here we're comparing Akamai to its peer group, other companies that operate in this space. You have choices. You have choices like, I like what Okta is doing. I think Okta is a good acquisition target because they do like the whole single sign-on, multi-factor authentication. That's all a necessity. And they do have big competitors. So Microsoft has the same features, same technology. Microsoft's massive. But maybe Okta can operate in spaces where people don't want to buy from Microsoft. They want to buy the whole thing from Microsoft. Palo Alto discounted by 1%, so it's fairly priced. So Akamai came up as a discounted stock. I still worry about that slow growth because its competitors are growing much faster. And I still have that story in my head that, hey, these guys are going to struggle. So I'm not sure I'm going to keep this valuation. So I'm going to put delete here just to make myself a note, come back to it. But I want to share what Gemini has to say about their growth. So Akamai's growth in the next few years is projected to be moderate overall, driven primarily by its high growth security and cloud computing segments, which are offsetting a decline in its legacy content delivery network. Okay. So they're having a part of the business grow and a part of the business contract. They're transitioning from doing content delivery, which, I mean, we're in a different era. 20 years ago, that was really important. Now, not really a necessity. Man, Gemini's doing a nice job. It's going to make me a better investor using Gemini. So Akamai, for me, it's a pass. I've got better options in their immediate space. The better options for me are Okta and Fortinet. But I'm glad you brought it up because if this thing were to be, let's say the market started to badmouth it, oh man, Akamai is it's a terrible stock. But see, it's caught a nice little rally here. I think that's what you were showing. Maybe a couple months down the road, because that's how I treated Zscaler. Zscaler was just getting bad mouth left and right. Like, oh man, those guys just a bag of hammers. Those guys are terrible. I'm like, no, I don't know. I don't think they're terrible. And I bought them, and then I sold them, and I made good money. So there's good money to be made on Zscaler. Went up 95%. And if you study Zscaler, they were growing. They were trying to get their profitability right and their free cash flow right, but they were growing. That's really important. And Shazam, caught the stock at the right time, made some good money, sold it. And I think I sold it somewhere around here. It went higher. And of course, you're like, oh man, I kind of wish I would have kept the stock a little longer. Greed. And then it sold off. So it's like, oh, okay, well, I guess I did the right thing. But I made money on Zscaler. Now I'm trying to make money on Fortinet and Okta. We'll see where those stocks go. And that is Akamai, full tour review of Akamai, security software companies. Now let's handle EQIX. Have no idea what that is. Equinix. What do these guys do? Equinix shortens the path to boundless connectivity anywhere in the world. Its digital infrastructure, data center footprint, and interconnected ecosystems empower innovations that enhance our work, life, and planet. Equinix connects economies, countries, organizations, and communities. So are they a connectivity company or a data center company? Too many fancy words. That you can tell a marketing person wrote that. Maybe somebody could just write it simply so we know what the heck they do. So this is Equinix. So multi-cloud. Okay. So they do data centers. Okay. All right. So a data center company. Okay, cool. Very good. I know what they do. So it's a data center company. This might be a good NeoCloud company to keep an eye on. I'm going to do a video on NeoCloud players. Let me see if Equinix is on my list. I'm going to do that video later today. So where is that list? Give me a second here. There it is. Equinix is not on the list. Well, they are now. They are going to be added to my list of stocks I'm going to look at. I'm like doing my homework in the middle of class here. Okay, so Equinix for the 1 year down. Wait a second. I thought all data center stocks were going through the roof. What's going on here? 5 year, not a pretty picture. Why? This is a REIT, so they own the data center itself. So these guys are like, what's the company? So they're not a NeoCloud company. They just own the real estate. They own the building. And then companies like CoreWeave or whoever, Google Cloud, they come in and say, hey, we want to rent some space from you. You got it. How much square footage do you need? How many racks do you need? Market cap, 75.2 billion. They paid dividend 2.45. P ratio is really high at 51. Strong buy. So this is a real estate investment trust. Very different than a technology company, okay? This is different game here. They're growing slow, but they're growing. That's good. You have to think that their properties gain value, right? Because data centers are become more valuable. SoftBank just announced, I think yesterday, that they're buying a data center company so that they have that capacity. Okay, so these guys, they're going to be a real estate investment trust, and I wonder if, all right, so it's not really showing me the funds from operations So I'm going to view it differently. See if it's over here. Nope. Okay. So the forecast is that they are going to keep growing. They should. They're in the right space. This growth looks really good. For a real estate investment trust, this is very good growth. Earnings per share is really expanding. They're more profitable. The forward PE, geez, it's elevated. Why is it so high? It's pretty high. And again, comparing it to other real estate investment trusts, I think you can, yeah, they're like DLR, Shadow Guy. You nailed it. DLR is out there. We can compare it to DLR. All right. So the way real estate investment trusts, I don't use cash flow. I look at their earnings per share, and I make sure they can afford their dividend. So their earnings per share is, so they pay $18.76 as a dividend. And when we look at their earnings per share for the trailing 12 months, they have an earnings per share of $10.98. How are they paying such a high dividend? Huh. So that's kind of a mystery. You're paying way more than what you're making. But maybe funds from operations. Here it is. Funds from operations. So they didn't give it to me by per share, but it's saying that they're paying out 77% of their funds from operations, which is appropriate. Okay. So the dividend rate isn't overly exciting, 2.5 or so. Growth looks good. DLR is they're a competitor. DLR provides data centers. And these guys are up a little bit, but they're not killing it either. And they're under stress. Why are these REITs under pressure? I would think that with such interest in data centers that these REITs would be catching a bid, but that's where my thinking got me. Dividends a little bit better, 3.16. They have a high PE ratio as well. Investors are not buying these stocks. They're saying, yeah, we don't want to buy the real estate. We want to buy the companies that are running the compute, that are leasing out these racks and trying to make something with it. So funds from operations per share, $6.69, and they are paying a dividend of $4.88. So they can afford that dividend. The forecast for DLR growth, better growth than Equinix, by the way. And their PE ratio is really high, but it should come down in future years. But man, I don't understand why their PE ratios are so high, because the stock prices have not been going anywhere. So that's kind of a little bit of a mystery to me. For me, Equinix would be a pass. I've got real estate investment trusts that the numbers would be far better than this. I could do 5% dividend. They can more than afford their dividend rate. P ratios at 12 to 18. I mean, that we're talking about real estate investment trust here. We're not talking about buying into Google. So for me, Equinix would be a pass. Just there's too many mysteries involved here. I don't like scary movies, by the way. I don't think I've ever shared that. I don't like scary movies because I know that someone's going to die, and it's just a bad outcome. Too many mysteries in a scary movie. And there's too many mysteries in Equinix. So I would pass on Equinix. Let me turn it over to you, Daryl, and see what you think of Equinix.
Okay.
I don't know. Do you like scary movies, or do you stay away from them like I do?
I'm not big into scary movies. I'll watch them, but if somebody else wants to watch them, but that's not my first place to go. So let's take a look at this one. They basically peaked out in November of 2024. We have this downtrend line here. One common theme that I see for pretty much all REITs, every one that I've looked at, it's on October 27th when the FOMC announced their latest rate cut, and then December was questionable, and then we got one more, but then maybe only one more left for 2026. Is every single REIT that I've looked at has done this. So when those rate cuts were basically, I mean, they were talking, what was it, 3 or 4 at one time, and now they're talking 2 for their next 2 years. That has driven the price of REITs down. So we could look at other ones if you wanted to check my thinking there, but nearly everyone that I've looked at has done this. They're trading below, they are in a confirmed downtrend because they do have a 200-day that's declining, and we have this downtrend here. The 50-day is right at this gap down on June the 26th. They've traded right along that gap price for months. They got a rise in anticipation of rate cuts, and then the rate cuts are not coming to the extent that was anticipated, that the market believed were priced in. So they started selling off REITs in general. They do have a PPO or a RSI that's above 50. PPO just did move into bullish. Nope, it's not in bullish territory. I see a negative sign over here. So it is just right below transitioning into bullish territory. Accumulation seems to be pretty flat over the year, ups and downs. You can kind of confirm that with the money flow going positive and negative. They've underperformed the SPY, as most REITs have. They're underperforming the XLRE, which is the real estate sector, by 20%. They are underperforming their industry group, which is specialty REITs, by 15%. And that industry group is also underperforming the S&P 500 by 14%. So this particular company is underperforming worse than the overall real estate sector.
All right. Let's move on to the next one, which is going to be, so Mike is interested in SPHY from a income generation perspective. So State Street portfolio, high yield bond ETF. Okay, so we have, let's talk about a couple of things first. So we expect it's going to be, I'm expecting for the next 2 to 3 years, we're going to have lower interest rates. The president's going to elect a Fed chairman that is going to have an agenda to lower interest rates. So I get that we're hearing kind of a, hey, are we going to go up or down? How many rate cuts? But to me, it's pretty important for me. And maybe I'm interpreting it wrong. I'm predicting it wrong. But if you have the chairman with a, I'm going to call it a dovish stance, which means, hey, let's lower interest rates. Interest rates are going to be lower. So if you hold long-term bonds at this moment, those bonds are going to go up in value because interest rates are dropping. And just to keep it simple, let's say you have a long-term bond for the next 5 years or 10 years, and it has an 8% yield on it. Well, if interest rates go down, that means bonds don't have to pay as much, and it's going to increase the value of your bonds. So locking in bonds right now is not a bad idea. Not a bad idea. And if you're looking for income, let's see if this guy is a good income payer and so forth. And let me say Happy New Year to Herdo. You're awesome, dude. You're a pretty generous guy on streams. Thanks so much for the big super chat. Thank you so much. And let me know if you want me to take a look at some stocks and you want to look at Path. Cool. We're going to look at Path. Let me pop that on the list. And Path that's been in my crosshairs a few times. All right. So this stock, and this is an ETF. So it's holding a pretty long list of bonds. Okay. Boy, is it diversified, huh? 0.46%, 0.39. Now, the good news is I buy individual bonds. It's pretty tedious. I'm glad I've done it. It's almost like I always want to do something to understand that topic better, right? And I've bought individual bonds. I've, traded them, and it's laborious. So ETFs are a pretty good idea. It saves you time, but I encourage you to understand it the best you can. And I'm trying to kind of decipher the code here. So what is the term on these? So symbol. So here's the date. Okay. So I'm focused on this guy. It has a coupon rate. The bond itself pays 3.875. If you were to buy it, let's say you bought $1,000, that's the issuing price. You'd be paid 3.875. Your yield would be 3.875. The bonds will go up and down based on market interest rates. So it might sell, judging from the maturity date, this thing's probably paying 5.5%, 6% yield, which means the bond price is coming down so that the yield will be higher. And it's going to mature in 2029. This one's going to mature in 32, 31. So this has got like a intermediate long-term position in bonds. I think that's a decent idea right now. I think this is going to go up in value. The yield 7.37. What kind of management fee are we paying here? Is that the net of expense ratio? Oh, I like that number. 0.05%. So that's super low. I'm liking this as an income source. If an investor is looking for income, okay, what you don't want is you buy into a bond ETF and then interest rates go up, because that's what happened in 22. And what happens is, okay, you bought this, let's say you bought $10,000 of this particular ETF at $23.70. And then interest rates go through the roof. And all of a sudden, this is priced at $15. And you're like, oh man, I just lost 30% of my ETF position. It's going to take years to get back to even, right? So if we expect increase in stock price or interest rates, be careful. Now, it's hard to predict, but we kind of have some pretty good information to work with. We got a chairman that's going into office that's going to have an agenda to lower interest rates. Or if anything, is leans towards, hey, wants to run with lower interest rates. And the economy is not like booming. It's not like, oh man, inflation's going through the roof. Everybody's buying too much stuff. No, we're not in that environment. Inflation's being controlled. Okay. So we don't have to use high interest rates to bring down inflation. So I would say this is a good idea for income. I would say that's if I was in a position where I needed income out of my portfolio, it's a pretty good idea. In fact, I'm going to note it. I'm going to keep tabs on SPHY. I like it. That's a pretty good situation there. Those are my comments there. Did you want to show something on your screen or just talk
Yeah,
about?
I can show actual results from this one.
Wow.
So
Who needs Gemini when you have Daryl?
Yeah, I've owned this since 2020, and I
Perfect.
bought at the wrong time. This is when interest rates and stuff were going up. But anyway, it's returned a lot more in dividends than I've lost in this one. So I just continue to hold these shares. My net investment's about $12 on these. So over a buy and hold period, for me, it's returned about 5.3%, only 2.1% annualized. And that's basically because I bought these. I was really new at this point, so I bought these just at the wrong time.
Yeah, and
So
remember the comments I made, guys, earlier, where it's like, hey, if you're going to have increasing interest rates, that's what happened to bond prices.
So 2021, I actually did okay with them, and then we had 2022, and then now that interest rates are kind of stabilizing a little bit, this is high yield portfolio, so it is. That's a good name for what they call junk bonds. So these are higher risk bonds. They're not Johnson and Johnson AAA rated company. These are what triple B minus and below. So if you look through that list that Victor was showing a little bit earlier, their holdings, you'll probably recognize some companies that would be considered higher risk. Then I saw Shadow Guy mention, you have to consider the default risk, and that's definitely true. The nice thing about buying an ETF over buying the bond directly is you're paying that 0.05 expense ratio per year, but you let them manage that.
Yeah, and you saw that they're spread across so many companies. It's like
Exactly.
if one of those companies goes belly up, okay, it didn't hurt the ETF very much. It's like you got tiny little exposure.
Yeah, I think you can generally assume in a big bond portfolio like that 4% are going to default. So it's not going to hurt you too terribly as long as you're diversified in a ETF. Where you're buying the bonds directly, you better do a lot more research. So since 2023, I mean, they've done really well. Pretty much tracks the technology is what I see. When technology pulls back, you're going to see a pullback in the price of these bonds, but they do pay a dividend of 7.12%. So I like getting that check every month since I'm retired. So hopefully that helps.
It does. That was a very good segment around bonds and, young investors. I'm going to just say what I would tell my two sons, 25 and 21. You don't have to pay any attention to bonds right now. You go buy companies you think are going to change the world and be phenomenal. Okay. Be good at picking stocks that 20 years from now are going to just grow your wealth. Now, if you hit 40, start getting really knowledgeable on bonds, because when you hit 60, you probably want income to be consistent, and bonds can really deliver that consistency. So I think bonds, back in the day, the 90s, right? Uh, Bill Gross, the bond king, that guy was really good. He would compete against, back then we didn't have ETFs, we had mutual funds. He'd be competitive with mutual funds for overall return. And he really got everything there was to get out of bonds. And those days are over. Those days are over. Like, bonds just cannot compete with stocks. It's a different game.
Another thing that's kind of interesting is Victor can probably explain this a whole lot better than I can, but there's a hierarchy. If a company does go bankrupt, there's a hierarchy of where particular equities land in the repayment of any saved money from the bankruptcy. So bonds are kind of at the top of the list. They get paid first. And then I can't remember. Preferreds get paid, I think, next. And then thirdly are equity holders. So I always like to keep that in mind, because there were some companies that went bankrupt, some pretty large ones, Tricolor this year and one other one. And in Tricolor's case, I think they owe a lot more than all of their tangible assets were worth. So probably not very many people are going to get paid, but the bond holders are going to get paid first. And then if there's any money left over, preferred stockholders get paid. And then finally, equity holders.
Perfect. So let's move on to the next stock we're going to look at. We have a nice list of stocks, everybody, and the chat is just going bonkers right now, which is great. A lot of chatter around.
This discussion really went gray-haired, man.
Yeah. So we've got 5 stocks to go, and we got Path next, and we're going to go into Microsoft, Court, Celsius, CBL. And if you got more stocks, I got plenty of time today. I don't know about Daryl, but I can go over time. It's like a football game. If we've got to play a 5th quarter, I'm all suited up and ready to go. Right now, we're going to focus on Path. UiPath is a stock in a company that I think is really neat. I believe that UiPath is truly an AI, born in the AI era company. They do software. It helps companies, what they would call robotic process automation. So in the US, Romania, United Kingdom, Netherlands, internationally, software robots that emulate human actions with precision, speed for organizations to automate repetitive tasks. I don't know. That sounds like AI to me, man. That really does sound like AI. And these guys were not a different type of software company before. And then they're like, oh, AI is the coolest thing. So let's just say we're full AI. We're all in on AI. No, they came out and said, this is what we do. This is all we do. Okay. We don't do anything else. It's kind of like, we do pastrami sandwiches. We don't do anything else. We're really good at making pastrami sandwiches. I had a pastrami sandwich the other day. It was really good. Anyway, so, but those, I can only have one once in a while, if you know what I mean. All right. This stock is up 29.58%. This was a new issuance back in 2021. And once again, this is why I'm careful with IPOs, because this thing came out and investors were like, hey, these guys are really interesting, really going to be valuable. And they may be right. But guess what, folks? I would say 80% of IPOs follow this trend. They sell off, because I think investors are kind of, giving them the hey, I'm going to wait a few earnings. We'll see if these guys really are everything they said they were going to be. So the 1 year looks good, but the 5 year, again, IPOs, I'm careful with them. They're an $8.8 billion market cap company. That is a really low market cap. 1.55 billion. Now, one thing that I've noticed about this company, P ratio is 22.6. Analysts think it's priced a little too high because it's been going up. Look at these spikes here. Wow. Looks really interesting. Now, it's growth. They have this is the right company for the times. So this tells me a couple of things, right? One, specifically about the company. Second, what I'm seeing about AI. Okay. But let's talk about the company first. 10% growth. I'm like, why is it so low? Right now, for the last 3 years, all I've heard is AI, AI, AI. AI is going to do everything. It's going to drive cab, robo taxis. It's going to, you're going to have AI write code. You're going to have AI do all customer service. It's going to replace people. There's a hiring problem for new graduates. That's all I hear. Well, if that's the case, UiPath should be cleaning up, like just killing it. But they're only growing by 10%. What's the problem? What is slowing these guys down? Now, when I focus in on the quarterly does look better, 16, and you see it's beginning to accelerate. Okay, so that looks good. That acceleration, let me show you another example. Because Palantir, right? Needless to say, it's been a very, very good stock for investors. And look at their growth here. They were growing, just doing great. Slow down, acceleration. Quarterly. No, quarterly is not going to show it. It's too far in the rearview mirror. But you get the point where it decelerated and then it accelerated. So if that's the case for these guys, where you see a deceleration and then an acceleration, I think good times are coming for this type of stock. Let me go back to the annual and look at the trailing 12 months. Gross margins. That top line gross margin number is a very good looking number. 83% is really good. They're profitable. Free cash flow at 20%. That looks really good. So good. This looks excellent, 83. And 20% is very good. Okay. So I'm good on that number. Free cash flow is $311 million. Forecast. So we got 14 analysts, price targets. But this is my money slide right here, is how are they going to grow? So in 2026, they're going to grow by 13.59. So they're going to keep this run of better performance on the top line. Profitability is going to be there. P ratio is going to come to the mid 20s. And then they're going to grow by 9.6. Now, I'm still in disbelief over the fact that, hey, why aren't they growing faster? AI is humongous. If I read all the headlines, why aren't these guys growing faster? Second, these guys could be acquired because, I don't know why Google hasn't acquired these guys, or Microsoft, or you name the big software company. These guys have the right business for the time. So I'm very positive on the business, very positive on what they're doing. I just want to see better growth, and just so that it's kind of like the dots for me show, like if I were to plot what should happen for a company that is a software company with AI, well, they should be going up and to the right. But these guys have been going up, but just moderately, which isn't good enough. They should grow faster. So let's take a look at Path's valuation. They are discounted by 23%. And I think Path is a buy. It's a total buy because they're just in the right space. Now, I have a background in software and I understand what Path does. In a way, we've been doing what Path does in enterprise software for some time. We call it workflow, and it's kind of what Path does, but Path goes all the way. They're like, no, you can use this software, and if there's a repetitive task, it will do it. That's like, I can't think of any business that would not be interested in doing that in this era. So it's a buy for me. It's a good looking stock, good looking company. If they start to grow fast, man, this stock's going to explode, and it is a good acquisition target. So those are my thoughts on Path. I like Path a lot. We'll see how it performs. Let me kick it over to Daryl, see what he has to say about Path.
We'll look at this news first because they are going into the S&P MidCap 400 index. That was announced on the 23rd. It will be effective this Friday. So once that news was announced, you can see they had a nearly 8% pop, 7.5% pop. Basically what that means is once they go into an index, anybody that replicates that index has to buy this company. They're going to have to sell the company that's coming out and buy the one that's coming in. So you're going to get a lot of passive investment in this one. I'm a little surprised that it's been selling off. This one, look at the amount of volume. All the other stocks we've really looked at today have had low volume. This one has had their 50-day average. Today, we're not going to count because we're still trading. So they have a resistance that I have set from October 9th high. They did break through that, but only lasted a couple of days and then sold off again. I have this longer term support set to this point, set at around $15.25. The 21-day is still rising. They're testing that 21-day average today. Looks like they tested it in the morning, or at least sometime throughout the day. They tested it once more. The 50-day had peaked out, decreased, and looks like it's back on the rise, and the 200-day is increasing. And the last time we covered this, I did mention this negative divergence. I'm always careful with stocks when I see those because it means that you drove higher prices, but the momentum wasn't as good as it was on the prior push higher. We did break down below 40 RSI after this surge here. So this was good news that they're going into the index. That's going to help provide some price support. And if this is one for you, then that's probably not a bad place to start thinking about getting in.
Okay. And so I like UiPath. So let's see here. I have my brokerage account open. I'll see if I want to buy it after this stream. So it looks good. I like UiPath. One last kind of checkpoint. Let's ask the Matrix Gemini. UiPath is projected to experience moderate revenue growth over the next few years. The Analyst consensus around 8.6% annually, but with stronger growth in earnings per share as the company focuses on profitability and integration of agentic AI. Okay. Yeah, it's these types of businesses like UiPath, we're going to see more of them. Meta bought a business. Not who, what company?
Manus.
Yeah, and what does Manus do?
They build, if I remember what I heard, they build some agents for AI.
See what I mean? UiPath, right? So Manus, Singapore-based startup with Chinese roots. Product focus. General purpose autonomous AI agent capability, independently performing complex digital tasks like coding, market research, data analytics. Okay. So it looks like Manus is going to replace you and I, Daryl.
Yeah.
You can take a few days off and just get Manus to do the streams.
There you go.
Integration strategy. Okay. So this is my point on UiPath could totally be a acquisition target. This is Meta buying this company. I think it's similar to UiPath, and we'll see what happens. Okay, let's keep rolling here. How you doing on time today, Daryl?
Doing good.
Okay. I think we've got like 20 minutes to go here. So the market's selling off. We're kind of going to fade into 2026. We'll see how next week trades. And look at the heat map, just a quick peek. Wow, man. Somebody decorated the heat map for Christmas for sure. Look at this. Whew.
Wow.
And you know what's interesting is we're not down that much, but it seems like a lot of these stocks are sold off just by a little bit. You know, like Google's down 0.2%. Couple, look at Berkshire on a risk off day. Hey, let's go to Berkshire stock.
Yeah, even they're celebrating his last day as CEO.
Staples are down. Energy, everything's down. Just a little bit of green here. The telecoms are up a little bit. Airlines are up. Remember, I was talking about how they are getting a lot of bookings. A lot of people are flying. And Nvidia's up a little bit. So it's a pretty red day out there. All right, so we're going to move to Microsoft. And Ricardo wanted to know, what's Microsoft looking like this year? I think it's a good idea. Microsoft early in the year was really doing well. It had its pressure, went up and kind of went sideways, 15%. So it's lagging the S&P. And the Microsoft business is really loaded. It really is a phenomenal company. It has both a legacy and a modern business. Its P/E ratio is 29, which we're going to look at their growth in a bit. I think it's reasonable. And analysts think there's a discount here. The reason I say it's reasonable is this is a massive business, $293 billion of revenue growing at 15%. So just doing quick math, that's about $45 billion of top line dollar growth that you add to the top line. So that means at their profit margins each year, they're just boom, growing the profitability and the free cash flow by that amount. So the gross margins on this massive business, almost 70%. Look at that profit. So back to that $45 billion of growth. At a 35% gross margin, that means that you're putting another $16 billion of profit in your pocket on the balance sheet every year with that growth. This thing is a phenomenal company. And Microsoft, the other thing about Microsoft is they've been near the top of the stack for 4 decades. Google hasn't been there. NVIDIA hasn't been there. Apple's been there for a couple of decades. But Microsoft's been there every decade, near the top. So we looked at their revenue growth. Let's look at their forecast. Microsoft also has a credit rating that is excellent. If you look at their bonds don't pay as much as other bonds because their credit is so darn good. Their balance sheet's really good. And they're going to grow. Look at that growth. These guys are growing faster than UiPath, except they're like 100 times bigger. And they're growing at a higher percentage. That is incredible, impressive. So for me, how do I invest? I'm going to talk about how I invest in the big caps because that's important to cover. Now you can play it safe and just buy all the big caps. Okay, that's one way. Or you can see, who's going to win the overall battle or the war, I guess. And Microsoft is Google's number one. Those guys, those are like, we got the NFL playoffs going on, and probably a couple of compelling games are going to happen. One of them is going to be the Baltimore Ravens playing the Pittsburgh Steelers. And man, that's going to be a game. Those guys are going to go after each other. That's similar to Microsoft, Google. These guys compete against one another. They've been competing against one another for a long time. I picked Google. That's who I think is going to win. That's who's going to win the strategy war. They have momentum. They both have, both feed in the AI market. Google has a big portion of OpenAI, that they own. They have big cloud infrastructure business. They're doing their Copilot business, which hasn't been doing all that great, but you got to give them credit for being one of the first ones out of the gate to do a pretty broad deployment of AI. So this isn't a bad choice. Microsoft for a while is looking like a genius move. And I think it's setting up with its pricing. Its PE ratio is right there with Google's. It's better than Amazon's. Not as good as Meta, but Meta's a different type of business. NVIDIA still has a really good PE, by the way. Look at that. So when I look at Microsoft from a valuation perspective, it's going to be a low-risk stock. I think Microsoft can deliver 10 to 20% appreciation for the next 5 years, which would be excellent, by the way. Microsoft's a buy in my book. I don't own Microsoft. I don't plan to buy Microsoft because I already own a tremendous amount. Google's my number one position. I shouldn't be buying Coke and Pepsi stocks. I shouldn't be buying Chevron and Exxon. It's like you're buying the same thing. So to me, Microsoft and Google are, man, they're kind of similar. So I think Microsoft's awesome. It's a buy stock in my book. It's solid company. It could be, I would say for any age investor, you study Microsoft, and there's a lesson when we study Microsoft for everyone. But the best lesson, or I would say one of the key lessons that I would encourage you to think about is we have great examples of what a company should look like. We have great examples of what fundamentals should look like. And if you look at Microsoft, that's what great looks like. If you look at NVIDIA, that's what great looks like. If you look at Google, that's what great looks like. And then we go to these small caps and say, okay, do you fit the great mold? Or are you going to fit the great mold at some point? Like Palantir is growing really fast, high profits, high margins, and high cash flow. So that's beginning to kind of put itself in a mold similar to Microsoft, which is great. So those are my comments on Microsoft. Let me kick it over to Daryl, see what he has to say about Microsoft.
Okay, one thing I'll point out is in their last 3 earnings, they opened at pretty much the high of the days and then sold out. That's what this black candle is, compared to a red candle where it opens lower and the price goes higher throughout the day. And it's also black candle's got to open above the previous day. So that'll give it a black candle. But the last 3 earnings, they've had these black candles each time. And with the exception of this one, where they continued rising, these last 2, they had the black candle and then pretty much sold off. So they were showing strength going into the earnings, and then I don't know what necessarily people were thinking, but they were selling it off. This one we've had light volume over the last 2 weeks. The RSI is in bearish territory. The PPO is in bearish territory. The accumulation peaked out back here in July, mid-July through the end of July. We are making progress with the accumulation. Money flow is currently positive. I'm going to step in a little, zoom in, because we have a lot of congestion down here. It's just been traveling sideways. So the 21 day is even going sideways and has been for, looks like, 2 weeks. The 50 day is declining. The 200 day is still increasing. I have this resistance line set at this peak. The next earnings, after the earnings, it came up and touched that almost to the penny and was rejected off of that. We have another resistance line set here at about 530, and it came up and was tested twice and rejected. And we have a shorter term support line down around 462 or so. I can't remember what your valuation on them are, but they're trading above what I consider fair value.
9% discount.
Okay, I have them as being a little bit overpriced, but regardless, this is a great company, and but they've been struggling in the last 2 quarters. They report earnings and they get sold off. I own them. I am a happy owner of Microsoft.
I owned Microsoft for 10 years and always knew that it was like, it's like owning gold. Like, it's solid. It's a good business. And I probably, I probably regret selling the shares, by the way. I own them. I did well. But man, it would most definitely be my number one holding at this point if I had held those shares. Welcome to stock investing. All right. So let's move over to Corcept. This is the next stock that was requested. I'm starting in Gemini because, man, when you look at this chart, you're like, what happened? Corcept Therapeutics went down significantly in late December, primarily due to the U.S. Food and Drug Administration issuing a complete response letter rejecting the new drug application for its new drug candidate for the treatment of Cushing's syndrome. So, needless to say, that's like really bad news for a biotech company. Do they have? So, And I'm asking, do they have other drugs that they sell? And maybe they do, maybe they don't. Let's see here. So they sell one FDA approved drug. Okay. All right. So this stock's really nosedived down 55%. It's a small cap, 3.5 billion, revenues of 741 billion. That's not a bad ratio. You're paying maybe is that 5 times, sales for the company. That's not bad. And forward P is 33. We'll see how they're growing. Analysts think it's discounted by 282%. That's a pretty good discount there. Maybe I should change my stock pick for 2026.
There you go.
Make it court. Let's see. So these guys, even though the FDA said we don't accept your application, they are growing trailing 12 months. The growth is pretty solid. I mean, it's not a tiny business, pretty good sized business. Be curious to see what their forecast looks like. And when we look at this gross margin, 98.19. So they don't manufacture, they license, they basically own the patents and they manage the sciences. And then they go to a company that manufactures the whole drug, or if it's an injectable, that medication. And they kind of don't get their hands dirty. Profit margin 14%, free cash flow 22%. So that's where that lies. Let's look at their forecast. And now this forecast may be it may include that drug, but man, look at this forecast. So this is homework time. The market believes it knows that this forecast is wrong based on that stock sell off. So if you could do the homework, you can see, hey, what's it going to be? Are they going to grow, mid-teens? I mean, this growth looks pretty good.
That news was just released this morning, so I can't imagine that it's been incorporated into these numbers yet.
Huh. That's a tough one. So, but it's an opportunity, right? Because the stocks sold off so much. It may take a while too. This one, it may take 6 months. And for sure, this one here, I would wait for the earnings, which is going to happen in about a month and a half. Early February is when they're going to do their next earnings announcement. That's when I would probably wait to get more information, get management's comments on this is, hey, we're going to reapply. We feel confident. The reason that they rejected it was there's the reason for it, and we understand it, and we're going to address it. Or maybe they're like, yeah, that was a bad idea to begin with. We're going to cancel it, but our core business is still strong, and this is how it's going to grow. I just need more information. So this one here would be a pass until the next earnings. There's just, this is a doozy of a drop, right? So now let's see how the charts look.
Yeah, I do see that the CEO has already responded. They had a press release, so they said we were surprised and disappointed by the outcome. Our commitment is unwavering, and we will find a way to get that drug to the patients if it can help. So they'll work directly with the FDA and see if they can reconcile this rejection.
The part about it, though, here's the thing is, if there was like a little bit of a gap between like, hey, they applied and there was a couple things wrong, or the FDA usually communicates privately and it's like, hey, this piece needs improvement, that piece needs improvement. but usually don't have a swing and a miss of this type. So obviously the CEO is going to say that because it's like, hey, you can't say nothing because then the stock would go like to zero.
Yeah.
So he comes out and he says, hey, we're going to address it, yada, yada, yada. I'm going to give it a month and a half and see what their earnings, what they say around their earnings. And maybe other things will come out. Like a story comes out and says, well, these guys, they were taking shortcuts and the shortcuts were really a bad idea. Who knows? Who knows? I'm going to give it time.
So on the chart, they've been pretty much trading sideways since April. They did have a little run in September, early October, and then right back down to those levels. And yesterday they were right at those levels, slightly below. And we know what happened today. And the RSI is oversold. The volume, look at that volume. So the average volume on any given day is right at 1 million shares, and they're trading 8.8 as we speak. So 8.5 times, almost 9 times the volume. And I think there's only probably 10 traders even working today. So, wow, that's a lot of volume.
And we're 2 of them, right? So that makes
it
8 more.
Yeah, we're gluttons for punishment. They were already in bearish configuration yesterday on the PPO. Today it's getting worse. So, yeah, I don't know what to say with this one. I'm kind of with Victor. This would be one to just wait a month or 2 and see what kind of news we get out of this one, and make sure they have other products in their pipeline. I have never looked at a presentation from this company, so I don't have any idea what's in their pipeline.
There's a lot of good choices in biotech.
Yep.
A lot of good choices. So do your homework and let's see what they have to say during their earnings. Now, something that doesn't need as much FDA approval is Celsius. I think the FDA just wants to make sure the amount of caffeine they put in these puppies isn't too much. But these guys, they sold off pretty harshly in November, and they're beginning to pick themselves up. Now, we valued this stock a few times over the last couple months. It's a small cap, 11.8 billion. Forward P 34. Strong buy, discounted. And these guys are growing, trailing 12 months. Look at that. What is going on, Celsius? So interesting why they sold off so much. When I value this stock, I'm going to show you in a bit that it's discounted. And their growth within beverage, right? Like Coke and Pepsi and Monster, if they can grow double digits, it'd be like, wow, that incredible. And these guys are growing quite fast in the current year. They're going to keep growing fast in 26, double digits in 27, 9% in 28. So that's pretty strong growth. And their profits are going to expand, bringing their PE ratio into the 20s. So there's a lot to like here, other than it's a beverage company. I don't like beverage companies. I think it's a tough market, and the margins for Celsius are good, by the way. They're good margins compared to other food companies. Very, very good margins. The balance sheet's fine, almost as much cash as debt, and the free cash flow is solid, 523 million. And when we look at the valuation for Celsius, discounted by 30%. And I'm curious to see what Daryl's seen, because I'm seeing a little bit of rise. And when these guys sold off, we looked at this stock like I'm going to say in the last couple weeks, and it looked good then. It's looking good to me now. So let me kick it over to Daryl and see what he's seen on the charts.
Yeah, I'm going to add one more little resistance point right there at that gap down, because I've seen a lot of these charts where they have a gap down like that, and it does seem to be a point of resistance. And you can see even 2 days ago, it came up and tested that and was rejected. And that's just above the 200-day. The price actually ended up closing right at the 200-day, and then it's been pushed down since. But they have had a little slight rise. 21-day has stopped declining about on the 19th of December and is moving higher. Just keep in mind that this push higher is on very low volume days. So look at the volume down here. We've had one day where it actually touched the 50-day moving average. Other than that, it's been very low volume. The RSI is in bullish territory, and the PPO is also in bullish territory, about a whisker's width into bullish territory on the PPO. Did have a lot of sell off, and it was selling off even going into whatever precipitated this drop right here. They had looks like there was some pre-warning there. It really needs to break out and, reverse these downtrends. So the 50 days declining, it needs to break out and get above that and start moving higher. Here's another cup with handle, by the way. So we're in a rising environment. We had a cup with the handle. So that was a price target of 77, and this one obviously failed. So I showed you two today where cup and handles actually failed. But I do want to show you one because I promised to do a video on this one, and evidently it hasn't been a high enough priority. Where did my mouse go? There it is. I'm going to go to one more because this one was kind of amazing. It's also not the Coke company, because that's symbol KO. This is the bottler for Coke. But look at this cup with handle. So I was asked on the 7th of November to review this chart, and this is what I drew for the person that asked. So they had a cup with handle. I gave him a price target of 162, and within 2 weeks' time, it hit that to the penny.
Nice.
Yeah, so these cup with handles do work pretty well. I've showed you two today that didn't work, so I wanted to make sure I show you one that did work. So anyway, that's it on that one.
Very good. And I like Celsius. I like the stock. I've never had a Celsius drink. I've never had a Red Bull drink. I've never had a Monster drink. I drink a ton of coffee, so
I've only had an energy drink once, and I had such a horrible reaction. I've never had another one. Except
I drink
coffee. That's my energy drink.
I drink espresso, like double espressos. I was in Europe 23, and I was in Italy. Had a great time. Man, I was so amped up because that's all they drink out there, right? Is espressos. And man, I was drinking double espressos all day long. And in the US, I just drink coffee. And like I'm barely, finishing my second cup of the day of coffee. But in Europe, I'd be like on, espresso, double espresso number 2, 3 by this time, and I'd be ready to walk the town. So I guess I don't have a need for energy drinks, but I know a lot of people love them, especially, I have a lot of relatives that love energy drinks. And I just I just observe it. I'm like, they like energy drinks. They don't like coffee. They like energy drinks. So that's that. Now, Celsius is discounted as I showed, and I did do a couple of searches here. Gemini is saying that there was no real specific, like, this is why the stock sold off. It was just noise. I think it's a good idea. It's a buy in my book. It's like, hey, there's a lot there. There's a lot of good stuff too. And this is kind of a smaller player that's outmaneuvering its competition, Monster and Red Bull. And the and I think Ben 10 is really doing some research here where the investment from Pepsi, that bodes really well for them. So overall, I think Celsius is a good one. I like it. So that's our analysis on Celsius. Good one. Looks like we've gotten to our last stock. This is the last stock we're going to analyze until next year.
Yeah, let's do a quick market overview on the carpet and see what it looks like too when you get done with this one. Or you can do it now whenever.
Yeah. So we're down. So again, we're kind of going to limp to the finish here, but it's kind of like marathon, right? The first, is it 26 miles to the marathon? The first 25 miles, boy, we had really good pace. And then the last mile, boy, we're just crawling on all four. And there's a lot of red on the screen. Look at that. Geez, look at here. Just red across the board. Interesting.
Yep, that's right, Mike.
Yeah. Interesting. Cool. All right. Well. All right. CBL and Associates. What do these guys do? Headquartered in Chattanooga, Tennessee, CBL Properties owns, manages national portfolio of market dominant properties located in dynamic and growing communities. CBL's owned and managed portfolio is comprised of 89 properties. Okay. And what type of properties are they?
Retail REITs.
Okay. And I think during the COVID times, boy, retail was like, you couldn't touch it because we didn't know what was going to happen. But we just got through this holiday season. I could tell you where I live, the retail, the retailers near me were packed with people. Like, wow, man. The consumer is out there shopping. And here's so they do hotel. Very good idea. So our portfolio. All right. Okay. And some of these mall properties where I live, they're taking the property and they're building multifamily housing apartment complexes, and they're building them around the malls, and they're creating kind of a pretty good lifestyle, which is you can walk to get a bite to eat, you can walk to get a coffee, and that's a pretty good idea. Like, that's happened on a few mall properties where, malls are not what they used to be, but it's smart that these companies are kind of innovating within what they own. And it's like, hey, we already own the properties. Maybe we can build some apartments there, and then we can have two sources of income. And it's a pretty good idea. I think it's a good idea for these property companies. So these guys are a REIT for retail. For the year to date, up 25%. Here's where COVID really put pressure on these guys, but they've recovered nicely. And the economy should be good for 2026. The unemployment rate is not a problem. I think low interest rates will be good. We have high tax refunds expected in the spring. All those things are good for companies like CBL. Their tenants are probably going to do well. PE ratio is super low, 9. Oh, man. Forward PE is 60, though. What happened? So pretty good dividend rate, almost 5%. When we look at their revenue, it has been growing. That looks good. And let's see if we got a funds from operations number. Yeah, $7.22. So they're making plenty of money to pay out their dividend. Forecast. See how many analysts are contributing to the forecast. None. Okay, so we don't have a forecast. So REITs. Now I'm not ready to buy a retail-oriented REIT. I'm still I don't like retailers, and Amazon just continues to change the world, right? Our family buys so much from Amazon. We don't go to retailers all that often anymore, as much as we used to, but a lot of people do. This isn't a bad idea. You have a good income stream. The stock has been performing. I think it's priced all right, especially considering the 5-year. So I don't think it's a bad idea. It's not a stock I would buy into. The REIT I'm buying into, they do housing for the elderly need healthcare, CTRE. It's been a phenomenal stock, really good stock. And there I understand the whole trend there, right? We have an aging population in the US. They're going to need housing when they need the combination of they need to be housed and seek medical attention. Maybe they're coming off some kind of illness. Boom. That's where they house people, and they've been doing really well. So I'm going to keep sticking to that. This one here looks good, but it's not right for me. What do you think about this one, Daryl?
They do look to be fairly new. It looks like they became public back in November of 2021. I don't know how long they've been operating before that, but they've been public for just a handful of years. Unlike most other REITs that I've looked at, they didn't really have the huge sell-off after the tariff news. So this one is kind of bucking that trend. They are trading above an upward sloping 21-day, 50-day, and 200-day. The RSI is right at 60, so bullish. It was overbought for a period of time, but it is coming out of that overbought condition. The PPO is positive. They did have a bearish crossover in bullish territory. Money flow has been positive since probably the first trading day of November or shortly after. I would have to do a lot more research into this one. I personally invest in Realty Income and Agree Realty, so I know those two really well. I know what kind of properties and retailers they rent to, so I would have to go in and do a lot more research on one like this before I could say yeah.
All right. And the very last one is Blackstone. Ricardo wanted to take a look at Blackstone, and Blackstone's been good for the last 5 years, but the last year hasn't been all that great. So this is an alternative asset firm specializing in private equity, real estate, hedge fund solutions, credit, and so forth. And these guys get involved in all kinds of deals. The last 5 years, it's been good. You know, they've had certain periods of they've flourished. It looks like they may be setting up to do that again. Now, the environment in 2026 should be good for Blackstone, which is, you have low interest rate environment. So investors might be, and I should say, those businesses seeking capital are probably going to go to Blackstone. Blackstone can charge higher rates of return on those investments so they can outperform. The forward P is 25. They pay a nice dividend, 2.55, and they're discounted according to the analyst.
What's their book value?
Let's take a look at that. So their book value per share. So book value per share, $10.72. And look at their book value's kind of been all over the place. 10, 12, 10, 9, 10. So it hasn't been growing a whole lot. That is not what we want to see. We want to see a growing trend. Looking at their forecast. Now, this business, I can never really get a good handle on. Are they going to be good or bad? I think it's a well-run company. Very good reputation. They're supposed to grow nicely. 25%, 20%. It's looking good. It's going to bring its PE down to the teens. It's just setting up really well. It's not an investment that I have. I don't think I'd make the investment just because this one here is a little bit like Berkshire Hathaway. It's got investments all over the place. So it's a big collection of investments, and it's hard to understand, what's going to make them good or bad. So it looks good from a high level fundamental review. It's had a pullback for 1 year. It could definitely begin to rally higher. You paid a dividend. For me, it's not the right investment for me, but I think other investors could probably do well with it. It's a pretty good cap at 190 billion. What do you think of Blackstone?
I own a couple of these kinds of companies, but not this particular one. I've never looked at them before, but they did have a sell-off from February down into April. They had a run back up to highs in September and have been drifting lower since then. So the 50-day is still declining, but they are trading above that 50-day. The 50-day did drop below the 200-day, which is also was declining. It seems to be rising at the moment. The 21-day is also moving a bit higher. It looks like there was a lot of sellers in the early morning based on the shape of this candle, but it looks like buyers come back in to drive the price not too far below where they closed yesterday. RSI is in bullish territory. PPO's in bullish territory. Looks like it could have a bearish crossover here shortly, and money flow is currently negative. We could draw some resistance line on here. One would be about right there. Support looks like it would be anywhere from 131 up to 135. So it looks like it's pretty much trading just below the midpoint of that particular range.
Thanks, Daryl. All right, guys. So let's go ahead and end the show. And we've got the contest going on. Geez, we got a lot of people picking stocks, which is great. We got people picking stocks that have flourished. We've got some picks where you got these stocks that have been sold off, and maybe they're going to bounce back and really, really kill it. It's going to be fun to track these. At the end of each month, I'll be reviewing, see which ones are performing the best in 2026, which ones are lagging. And at the end of the first quarter, the winner measured by the best percentage gain, and it has to be a US-based stock, or at least traded on the US stock market, will get a subscription to Stock Analysis. We'll do that at the end of each quarter. There'll be a prize. But thanks for all of you that have put down a stock. If you haven't already put down a ticker that you'd like to go with, just get it to me by the stroke of midnight Eastern time, same as the stock market. Tonight, so 11:59, Cinderella's pumpkin. carriage will turn into a pumpkin. And so get that over to me. It'll be fun to track. And that'll be our contest for 2026. So that is it. Thanks so much, Daryl. Great work. Great work in 2025, by the way. It's been a pleasure to work with you. I look forward to many streams with you in 26.
Yep, the pleasure's been mine, Victor. I really appreciate it. Just want to wish everyone a safe and happy new year, and be careful out there tonight.
Yeah, 10-4 on that. Everybody, happy New Year. Thanks for tuning in to our last stream of 2025. It certainly was a pleasure, and it's been awesome to have these streams throughout the year. Just continue to improve the streams and based on your feedback. And really, your participation makes the stream. Today's stream was awesome. You guys were all over the chat. Thanks so much. All over asking for stocks, and really make stock investing fun. And I hope the analysis makes it interesting and just helps you have one more lens into a stock that you're interested in that is useful as you make your investments. Everybody have a terrific day. Have a good night. And we will talk with you next year. Take care.